Jackson, and with me is Ashresha Advarya, and we are taking you through all that's happening in the market. And we also, as of now, if you look at Nifty, that has been in the red for now, but that has turned green, though it is absolutely flat with a very marginal uptick, but it's flip-flopping between the red and the green for now. But we're talking about the earnings, and earnings season is in full swing. So let's get on board the management of Metropolis Healthcare that has reported its quarter earnings. As of now, we do see the net profit that's up 13% on a year-on-year basis. We also see the revenue that's ticked up to 22% on a year-on-year basis, and the EBITDA that is up 20%, but the margins are taking a knock of 50 basis points on a year-on-year basis. The stock is absolutely flat right now, but we have the management, Surendran Chemmenkotil, who's the managing director of Metropolis Healthcare, who's now joining us. Hi, thank you, sir, so much for joining us. As compared to quarter one of FY26, you have delivered a notable improvement in the margins this quarter, despite the moderate volume growth. What were the main margin drivers? Was it the operating leverage, the test mix, or the cost optimization that led to this?
Good afternoon, and good afternoon to all your viewers. Yes, definitely we have had a very, very strong quarter in quarter two, and both our revenues and our margins have got better. In fact, in quarter two, the margins are better than the quarter one by almost a couple of points. The reason being quarter two is normally upward quarter in terms of year-on-year revenue growth because of the seasonality. That definitely gives us definitely a lever in terms of margin growth as well. So quarter one versus quarter two, almost 8 to 9% of revenue growth you could see, right? That helped us in terms of improving the revenue, or that's flowing into the revenue as well. That's one piece, but at the same time, we are taking significant actions in terms of correcting our margins and improving it, both in the organic business as well as the acquired entities. So in the organic business, you can see it's almost about on a year-on-year basis, you can see some 40 basis points improvement on our margins. So this is coming on the basis of the various productivity initiatives and cost initiatives that we have undertaken. And also on the inorganic piece, the core diagnostic EBITDA was in low single digit in quarter one. Now it has gone into high single digit in quarter two. So that's also reducing the gap on the overall EBITDA dilution that's happening because of the acquisition. So overall, I think the progress is absolutely promising.
All right, so the progress is promising, but if we talk about your guidance, you had guided for 7 to 8% organic growth and 10% plus growth at the group level. Given that you've done so many acquisitions this year so far, do you expect to surpass your own guidance for the full year?
Well, 7 to 8% is only patient volume growth. That's our guidance, So I think the H1, we have done a 6% patient volume growth on an organic business and about 11% patient volume growth on the overall group level. At the revenue basis, I think we have given a guidance of about 22 to 24% revenue growth. And we stay put with our promise that we made in the beginning of the year, or the guidance that we given in the beginning of the year.
Right. Also, you have plans to expand the radiology, but it is quite capital intensive. How will you fund the scale and higher end radiology without impacting your margins?
Well, this will be a very gradual progress that we will be making. As we speak, we have about 35 centers in 5 cities. We're fully equipped with all the radiology testing capabilities that we need, which is X-ray, the ultrasound, the ECG, and 2D echo, etc. So all that we have already set up in 5 cities, and ECG is available across the country now. So the basic radiology part, we have already made a very, very strong beginning. And as we go forward, we will keep looking at how this is actually spanning out in terms of helping our revenue growth, and then we will keep expanding it as and when we require it. High-end radiology, we're still in the process of discussing within the organization about where and when we want to get into the high-end radiology, which is what is a high capex intense. The basic radiology is not a very high capex intense business.
Understood. So that's as far as your expansion plans in radiology business are concerned, and what the outlook is when it comes to revenue growth and expansion plans going forward. Thank you so much for taking your time out and joining us here today on ET Now. Thanks so much for joining us today.